Hello, class. As promised, this is our discussion of Chapter 4, and we're going to get into more detail about AGI and specifically those particular deductions that reduce AGI, that are what we refer to as 4 AGI deductions. So in Chapter 2, we introduced the idea that there are deductions that reduce AGI, and that AGI is an important measure because that's how we determine a lot of our phase-out situations for various credits and other deductions, is where our AGI is. So we've found one very important in Chapter 3 having to do with Social Security. It was a modified AGI, but it was the same idea. The level of income determined how much of your Social Security is included in your income. This is a similar situation in that we're trying to talk about things that influence AGI here. Now, before we get into the actual stuff, this is all of the adjustments to income. Out of the deductions we're going to talk about are on Part 2 of Schedule 1, which is now on a second page. So they put all the adjustments to income that are positive, meaning add to your income, on page 1, and those that are subtracted on page 2. So that's what we're going to focus on, is those deductions here. There's a couple we're not going to talk about. One we're not going to talk about, and I just want to point it out because it's a little confusing. See it circled here, line 12, certain business expenses of reservists, performing artists, and fee-basis government officials. There used to be a deduction for most everybody when you had a business expense on behalf of your employer. You might be an employee, but you run in your personal vehicle to get something for that business. That was a business expense and used to be deductible. It is no longer. And so Form 2106, while it still exists, is only for those three groups of people: reservists, performing artists, and fee-basis government officials. Because that's so narrow, we are not going to talk about what goes into that. Okay, so it's circled here as something we're not going to worry about. Don't get that mixed up with business expenses that used to be deductible prior to 2018 for lots of people. Now they are very, very narrow. Now, the other thing is we're going to talk about moving expenses, and we are going to do with this, even though it also used to be deductible for everybody, is now only deductible for members of the armed forces. So you see that circled to remind us, and we'll talk more about that, what goes into that later. And then down here, another note. For 2021, there is a deduction for charitable contributions. It is technically not a 4 AGI deduction. It comes after we calculate AGI. But it doesn't really have any other good place to talk about it, so we want to point it out there, but also tell you that it is technically not included as a deduction for AGI, like the rest of what we're going to discuss here. We're going to go through these, but here is where it would be. They would all be reported on the return. If there's additional detail needed, they may have an additional form beyond Schedule 1 that you see here. First one, probably the most applicable of all of them, especially for our audience today, is student loan interest. Okay, so it has to be a qualified student loan. It's just the interest part, not the principal, not the payback of how much borrowed, okay? And if the situation is that you borrow money and didn't use it all for education, then only the part that is used for education, the interest on that. So if you use half of it for education, then half of the interest would be included in this deduction. Only $2,500 per year. So regardless of how much you pay, the maximum that you can deduct for AGI is $2,500. Okay? What do we mean by qualified educational expenses? And you see the list there. It's pretty broad, but it has to be for those things. All right? Eligible education typically means someone that is eligible to receive federal financial aid. So it can't be just somebody down the street that's going to teach you something. All right? That sort of thing. It's got to be somehow related to the loan. You can't be that you took out a loan and then pay for the expenses years later. And it's got to be while you're a full-time student. It can be undergraduate or graduate, doesn't matter. But you have to be working towards some type of a credential. So this has a phase out. Like so many other things, once your AGI gets to a certain level, okay, then it starts to disappear, the deduction for it. Okay? So it's modified AGI, which is just AGI with a couple of things added back in, okay, including the deduction for student loan interest. You got to not include it when you're calculating the phase out. And the tuition and fees deduction has gone away. All right, so that's not an issue for 2021. So you start with how much you paid in interest. If it's over $2,500, you use $2,500 instead. Okay, that's your tentative deduction, assuming that you used all of the costs, all of the loan amounts for your education and the qualified education stuff. Then you have to apply this modified adjusted gross income threshold. Okay, if it's on a joint return between $140,000 and $170,000, a single return between $70,000 and $85,000. And so what happens is you get the full deduction if it's under, your income is under 70, is your single. You get part of it between 70 and 85, and you get none of it if your income is over 85. All right. If you're in between, then you take the deduction, you multiply by the fraction as we see that, right? The amount you're over this threshold divided by 30,000. So if you're halfway through the two threshold amounts, if you're married filing jointly, remember it goes from 140 to 170, that's the 30,000. So if you're halfway at 155, then you would get half of your interest disallowed. And it would not be counting as a deduction for AGI. And the rest of it would be deducted. Okay, so you've got the limit of 2,500. You've got then the issue of phase out based on income. All right, next for AGI deduction, health savings account. A little bit about health savings account. This is a way to save, put aside money now that will allow you to pay for medical expenses later or right away, okay? If it is done in the correct way and the money is taken out and used for medical expenses, putting money into it is a deduction, and taking money out is not income. Okay, so you have your dependents. Again, remember we talked about dependents are important this is another situation where you can take money out for a dependent, but not for someone who doesn't qualify as a dependent. If you make the easy thing is if you just make it your contributions to the HSA, you just put it into the account, then you would put it on your Schedule 1 of 1040 as a for AGI deduction. All right. If your employer puts it in on your behalf or withholds it from your check and puts it in, then that's not income either, but you won't have to worry about it putting it on the 1040 because it will be taken out of your income on your W-2, or it should be at least. So to qualify this, you have to have no other plan or have a high deductible policy of your own, on your own, or your employer, okay, pays for that. Okay. It has to fit the certain things for the high deductible plan. You can have coverage for accidents, disability, dental, vision, that sort of thing, but you can't have another health care plan. This has to be the one plan you have. All right. And so you can't just have an HSA without a high deductible health care plan, health insurance plan. It doesn't work. It's not an HSA and doesn't qualify if there isn't this high deductible plan. So what qualifies as a high deductible plan? Minimum deductible. Notice those as a minimum deductible, $1,400 and $2,800. It can be higher. All right. But there's a maximum deductible and out of pocket. So that typically you reach your deductible and then you pay a percentage, maybe 10% of anything over the deductible. And then you reach a maximum out of pocket, meaning at the point that you have paid this amount between the deductible and the co-pays, the percentage, then the insurance kicks in and pays 100%. All right. So at family coverage, for instance, once you have paid in the deductible and out of pocket up to $14,000, then the insurance kicks in for 100% after that. That's what has to be for it to be qualified as a high deductible plan. That's the deal it needs to have in the contract. You pull money out, put money into this health savings account, then you should get an Form 8889, or you must file that. You're going to get a report from a 1099 from the keeper of the plan. Okay? Usually the plan is done by a trustee, insurance company, bank, other financial institution. They have to be approved. They make sure that there's a record of all of the money going in and coming out, so that if there's ever a question as to how much it was, we have documentation to tell us what the amounts is. All right. All right, as promised earlier, talk about moving expenses. Remember, these used to be these used to be for everybody. Now they're only for military families. Has to be on active duty because of the change in station. Notice the idea that it is only those things that are unreimbursed. If the government or someone else reimburses you for your moving expenses, then they can't be deductible for AGI. All right, so there's the definition of what a permanent change of station means. So anything, if the military pays for it, it's not income, okay, to the military personnel. If they don't pay, if you don't get paid for all of it, so you incur so much expenses and they pay part of that, the part that you are reimbursed isn't included in income, but it also isn't included in your deduction. Most of this is worked out in their W-2, okay? And if it's more, if they reimburse you, give you more than you needed, the cost, if you reimburse you more, let's say, for instance, they give you a $5,000 allowance to move, but your costs are only $4,000, then $1,000 must be included in your income. Okay? What gets included? Anything to make is moving, get stuff from one place to the other, get the people from one place to the other, get the stuff from one place to the other. Storage when you get there, okay? People that are part of your family, so airline tickets, rental truck, all that sort of thing to get the stuff and the people there, car, but what is not, okay, is meals, okay? No deduction for meals, no deduction for unnecessary side trips. Technically, you're not supposed to spend too much on lodging while you're traveling, but it is deductible, okay? If you bring your vehicle you own, now if you rent a truck from U-Haul, they're going to charge you per mile. That's going to cover the wear and tear on the vehicle and renting the truck, and then you're going to buy gas along the way. All of those would be deductible. If you're driving behind in your personal vehicle to say get the people there that you need to get there, then you can use either keep track of all of your gas that you spend on the way, or you can just track the miles, figure out the miles on your Google Maps, and use 16 cents a mile, standard mileage rate. It was so much easier than trying to keep track of your various receipts and that sort of thing for gas along the way. Foreign move, okay. There is expansion. There are some of the things that additional storage and household goods from storage back and forth that come if you are moved to another country.